Hi, everybody. Dan Weisskopf here, ETF professor and also lead ETF strategist and portfolio manager with Mike Venuto, of course, of Block. Thanks, everybody, for coming. Looking forward to having a great discussion with our friend from Canada. So I'm going to go to David.
How's it going, everyone? David Chikansky here, fellow portfolio manager. I focus on the SoFi Be Your Own Boss, Gig Economy BYOB ETF, as well as the Amplify Inflation Fighting iWin ETF, and very excited to get into the weeds of the intricacies of the ETF marketplace in another country, because everyone kind of always assumes it's just the same, and it certainly is not. And I'll now pass it on to Cynthia Murphy.
Hey everybody, live at 5. Don't forget to say our catchphrase. We're excited to be here. I'm head of research for the ETF Think Tank, and we cannot wait to talk to Michael about all the ways in which Canada has been first in the ETF space in a lot of things. So Mike, you introduce yourself and then pass to our guest.
Okay, so Cynthia just let it on. Our toasting word is going to be first. And it's bittersweet, right? Canada first ETF, first Bitcoin ETF, first money market ETFs, first ones to have an actual lobbying group on behalf of the ETF industry. So we should all be drunk just from those amount of first. So I'm excited because this is a cool show in that, I've been fascinated with the Canadian ETF market. I have a lot of friends who work up there at Purpose, at Evolve, at BMO, at Horizons, because of my old Global X ties. So it's great to hear about this. We've got a lot of cool information from Michael even before this show started, just talking with him. And we got to all this because his organization reached out on Twitter and said, hey, when are we going to talk about Canada? And I'm excited about it because there's so many things that I want to dive into that I've only ever heard about from issuers in Canada. So I want to know. I also see we got a lot of friends of ours from Canada joining, so that's exciting. So I'm going to kick it to Michael. Why don't you share with us your background and a little bit about your organization?
Sure. So I am most seriously from an issuer myself. I ran the business for the 6th largest ETF issuer in Canada, but I've been in the ETF space for about 20 years, both on the buy side and the sell side. Last 15 working with leading asset managers to build their ETF ecosystem. Concurrent with that, I have been a board member of the Canadian ETF Association, otherwise known as CETFA, since 2016, and I'm the sitting chair of CETFA as well. CETFA, not unlike ICI in the US or IFIC, which represents the investment funds industry in Canada, is a community that supports the growth, sustainability, and integrity of the Canadian ETF industry. So whether it's in issues of regulatory or structural matters, whether it's in terms of education and visibility for Canadian markets, serving the best interests of our Canadian membership, and advancing and educating the marketplace on all things ETF related. And as you alluded, Michael, we are, to my knowledge, the first such association of its kind in the world. So that's something to be proud of. We represent in excess of 90% of the assets in the Canadian industry. And of, I believe, the 17 issuer members that we have, as well as affiliate members representing other segments of the global ETF or the Canadian ETF ecosystem, it's a world-class group of people, many of whom you're familiar with, that represent and lead within the industry. And it's a lot of fun. I'm very proud to be associated with the Canadian ETF Association.
All right, so I'm going to kick it off and then let's use the hands from there, guys. All right, so first one, geez, I didn't know if that word was going to work, but apparently it does. Why is it that Canada does beat us to things so often, right? As you like, what is it that makes Canada different that allowed you to get, I'm not going to say it, I guess don't have any choice. The first ETF.
Ahead of us.
You got the first ETF, you got the first Bitcoin ETF, and a number of them. You've got spot Ethereum, you've got money market ETFs, which blow me away. I mean, it's like the greatest investment in the ETF structure I've seen. How come it can be done in Canada so differently than here? What is different? Like I can tell you, Title launches ETFs for entrepreneurs and we help them grow it. Best case scenario, you come to us with a good idea, we can get it out in 90 days. We had a good idea. Some took our idea and did it in like 40 days. How come you guys are always first? What is going on?
Well, we could probably spend the whole hour talking about that, but listen, the US ETF market is much larger. It's more mature. It's the the global standard for ETF issuance, and in many respects for innovation. It's the most liquid market in the world, but Canada can lay claim to some firsts, as you mentioned. The first ETF launched in 1990, but as I understand it, there was a group at the American Stock Exchange that was working concurrently on their own version of exchange traded mutual funds and ran into some snags, regulatory, commercial, and otherwise, that kind of delayed their time to market, allowing Canada kind of to squeak in the door in 1990, but a full 3 years ahead of SPY coming to market. Along the way, though, we also laid claim to some other firsts. The first fixed income product was launched here. The first currency hedge product. You mentioned a couple of others like crypto. Cannabis was first launched in the Canadian marketplace. So we can lay claim to a number of firsts. I think it's a reflection of a number of considerations. We have a very supportive regulatory environment that embraces innovation, that embraces the best interests of investors. But we've also benefited from our close kinship with the U.S. market. And I think along the way, U.S. issuers have used the Canadian market as kind of a testing lab for new ideas, for new innovation before they come to market in Canada. But there's a lot of great thought leadership, innovation coming from the Canadian investment management ecosystem, close partnerships with capital markets that have all served to form a very innovative environment. But you want to be mindful, and the regulators and issuers and other members of the ecosystem are mindful of over-engineering and want to be sure that you're taking prudent steps towards approving for that innovation. You could argue that the SEC is a more deliberate body in some ways with the, or at least before the new ETF rule was introduced a couple of years ago, it was prohibitively time-consuming for issuers to get to market with new products without an extensive process of getting exemptive relief. So I think the U.S. is playing some catch-up in that regard. And it's not a question of advantage or disadvantage or blame or anything like that, just different geographies, different regulatory bodies. But certainly in Canada, we benefited from the innovation and the regulatory support along the way that has allowed us to create this innovation for Canadian advisors and investors.
But so from a regulatory perspective, oh, sorry, David, you lowered your hand. So I was just going to follow up real quick.
Go for it.
Does that mean, are we doing a better job of protecting investors? Because as far as I understand, all these gates are because we got to protect our investors from bad shenanigans in the ETF world. Are we doing a better job at that, or are we overzealous?
That's a really good question, Cynthia. I don't think it's a better or worse job. It's just a different job. The SEC has taken a different perspective, for example, on transparency. And before this ETF rule, there really wasn't a market for things like active non-transparent products. So I think the regulators are evolving, but have taken a different tact over time. In Canada, as an extension of that example, it's much easier to get to market with active products that do not satisfy the transparency requirements that the SEC has imposed in the past. It's not better, it's not worse, it's simply different. And we think we found an attractive workaround to ensure that we have NAV and price integrity, that market makers or liquidity providers have adequate transparency of their own for hedging purposes, for effective arbitrage to be worked into the ETFs ecosystem, and that we have efficient trading in the Canadian market, even though these active products don't necessarily provide that daily disclosure. So it's not necessarily better, it's just different. But I think by and large, we have proven that this innovation is being undertaken prudently, that it is differentiated, and ultimately, and most importantly, it is serving the best interests of Canadian investors.
Want me to go? David, or you want to go with your question?
Go for it.
So I'm going to be tacky. Last week I was bad. Today I'm going to be tacky. My tacky question is, how do you fund the organization? Because, Michael, your time costs money, right? Is everybody pitching in percentage of their other assets, or is there just a straight up cost? How does all that work?
Yeah, we have a pretty simple membership structure as it relates to fees. It's obviously a nonprofit organization to begin with. So we do draw membership fees both from our issuer members, but we also have a broader group of affiliate members from across the ETF ecosystem representing legal firms, custodians, index providers, portfolio managers, adjacencies within the ETF ecosystem that all see value and benefit in the advocacy that CETFA brings to bear. But to be sure, as a nonprofit organization for where all of the work is done on a volunteer basis, it is a significant time constraint. We have world-class membership, at both the issuer level as well as the individuals that I get to work with every day, representing the board and the various subcommittees that support us. But it is volunteer work. It is part-time work. Everybody that with the exception of Pat Dunway, our executive director, who does an admirable job in her own right as the only full-time employee of CETFA, everyone else is doing this on a volunteer basis and lending their expertise as they can towards various aspects of that oversight and advocacy. It is also, interesting how membership at the individual level has improved over time in terms of diversity. So it's not just business leads that are representing the association. We have, legal representation. We have product heads. We have distribution heads. We have business leaders that represent that diversity of thought, and I think inform better decision making, a better approach to how we look at governance, how we look at our effectiveness as a trade association. But it can be a little bit challenging at times because most of it's done on a volunteer basis by the membership.
David, I know you want to go to the product stuff, but let's stay on this one more minute on just the industry before we go to product. And then I promise I'll let you get in here on the money markets. So Mike, I also want to talk about the diversity of the Canadian issuer market. Like one of the things we have in our deck when we talk to somebody new who wants to launch an ETF is we say, hey, this is Thunderdome. This stuff ain't easy, right? There's 90% of the assets are with the top 5 issuers, right? Like BlackRock, Vanguard, State Street, they control 80%. Like this is, you get through the top 20, and we're talking about like less than 1% people are running after. So it's hard here. Now, I mean, you were telling me some stats in our pre-show about the issuers that are there. I want to hit on that, but I also want to hit on there isn't a company that does what we do in Canada. There is no white label. So it's amazing to me how diverse the amount of issuers are, but there's not this, hey, I'm an entrepreneur and I want to launch an ETF. There's no company for them to go to. We hear it all the time from our clients. I want to do Canada. We don't have a place to send them. Help us out here.
Yeah. Well, we have a pretty robust environment for sub-advisory in the Canadian market, which might, sort of proxy for that white labeling where, you've got a core competency running a particular asset class or investment strategy. You find an issuer in Canada that has access to that all important distribution. And we'll talk about that, I'm sure, in more detail. But I think that's how we've seen it to date for, offshore asset managers that want to enter the Canadian marketplace. They've found other creative ways to do it. I think we will ultimately see more in the way of white labeling. But again, absent that all important access to distribution, 10 years ago, when there was a lot more white space in the industry, we had a fraction of the products in market that we have today. I think it would have been easier for that particular business model. But today, you need to be clicking on all center. You need to be fully committed to the space. This is not for the faint of heart. We've talked about it. You might have a really compelling IP in terms of investment management, but you need to be able to tell your story. You need some brand equity. Unless you check all of those boxes, it's really hard to build profitable scale in any market, in any industry, but certainly in the Canadian ETF market. To your other point, and this, I get asked a lot about the maturity of the Canadian ETF market. And I look at how it's continued to evolve. I look at the fact that 10 years ago, the largest Canadian ETF issuer had 84% market share. By 2016, so 5 years forward, the top 3 issuers had that share. Now, 85% market share is held by the top 7 issuers. So it's really reflective of the fact that it's still very much a market that's in its infancy, in its growth phase. And as is the case in any industry, that's often accompanied by frequent turnover at the top of the league table. And we continue to see that in the Canadian marketplace. I think things will stabilize and settle out as we go forward. But another point that we talked about in the pre-show was that where we think of the big 3, right? Your viewership knows who they are. And in the US, they command between 75 and 95% of their market share from the US. It's very different once you move beyond US borders and you look at markets like Japan, for example, where it's local asset managers like Nomura or Nikko or Mitsubishi that dominate the ETF league table. They have access to the client relationships, they understand the regulatory environment, they understand investor preferences, they have brand equity in their local market. And I think Canada's more akin to that kind of environment where you need to have boots on the ground, you need to have that local presence. And I think as the industry in Canada continues to mature, already 8 of the top 10 issuers in this market are effectively Canadian businesses. So it's already, felt in the marketplace here. And I think that's going to continue to resonate very loudly in the marketplace because you need to understand your local investment culture and manufacture solutions for that local market. Like I said, understand the regulatory environment. And I think that's somewhat unique about the Canadian market, but we see it in other smaller geographies around the world as well.
So Michael, you threw out a kind of a staggering statistic that, and maybe I heard wrong because, well, sometimes I do that. You said that 90% of the assets by registered investment advisors are aligned with your organization?
No, we represent on behalf of 95% of the Canadian listed ETF assets. So we have 17 provider members that account for 92% of the total assets in Canada.
I got you. And how big is the asset base of Canada in terms of ETFs?
We're currently about 344 billion CAD. Now, if I layer on top of that, though, the roughly 60 billion of US listed ETF assets held by Canadian retail, and then probably another 60 to 70 million held by Canadian institutional, you can add another $150 million to that total of ETF assets held by Canadians.
I think you mean billion, right?
Yeah, billion.
Yeah.
Yeah.
All right. Debbie's got one, so let's bring Debbie up. And David, I promise we will get the product, but I want to get through the industry first.
Yeah. Hey, Michael. Nice to see you.
Debbie. You too.
So I was thinking it would be useful to talk a little bit about how you don't have James and flows and who's trading, and also kind of the history of IROC and MFDA, so that fragmentation, because I don't think people in the US appreciate how trading's different and also the advisor market.
Yeah. So on the second point, Debbie, yeah, the equivalent of the Series 6 market in Canada is a lot bigger, relatively speaking. Not necessarily in terms of assets under management, but the number of advisors that are non-securities licensed in effect. They still do a wonderful job and they offer comprehensive financial planning, including investment planning. But a lot of these advisors and dealers are not securities licensed per se, so they can't buy ETFs directly. But where we've seen arguably more innovation is in the packaging of exchange traded funds into more traditional mutual funds that are accessible to this Series 6 equivalent distribution channel, because there's just a strong an appetite for the ETF investment experience within this channel. The transparency, the simplicity, the cost effectiveness that we all associate with ETFs is just packaged into the more conventional mutual fund structure. And generally speaking, the most popular of these products are packaged as sort of like balanced portfolios. They might be comprised of 7 to 10 different underlying ETF building blocks with traditional, 60-40, 70-30, or other target risk blends, but still conferring to the advisor or to the investor the benefits of cost effectiveness, simplicity, transparency, just in a more accessible wrapper for that audience. So that's been a significant driver. Typically, Assets in this category, though, are lumped in under institutional. So as we know, and as this industry continues to mature, you really have to get into the nuance and the detail of what distribution channel dynamics look like. So, you know, the institutional bucket is broadly encompassing of your traditional asset owner or asset manager, but there's a broader spectrum of different investor types that populate the institutional bucket, which would include, you know, mutual fund manufacturers that are wrapping ETFs into that mutual fund structure. Debbie, I'm not sure I got all of your first question about the trading environment, and I think you're talking about liquidity providers in the Canadian marketplace.
Yeah, sorry. So like the fact that you don't have flow in Jane, the market in Canada is quite different. Sorry, I'm actually out eating dinner.
That's okay.
Apologies.
Yeah, we don't have some of those, although increasingly we do. We've worked very closely with Jane and other U.S. liquidity providers in the past. They offer world-class capabilities and competencies that complement those of the Canadian capital markets ecosystem. It is dominated by the Canadian bank dealers, as you probably know, but they do a phenomenal job of providing orderly two-way flow, top-notch trading efficiency execution, seed capital, business partnership as and if required. So I would suggest that we have a very robust environment of market making and deep liquidity that's of course being accentuated by the growing ecosystem of ETF users that of course are contributing important secondary market volume. And you know, as that becomes a virtuous cycle, you see more institutional and retail investors that become more comfortable trading Canadian products. You know, I talked about cross-border ownership by Canadians of US listed products. Well, in the absence of choice and competitive fees and liquidity, you know, going back 5 or 10 years, Canadian institutional and retail investors had no choice but to go across the border to find exposures they were looking for. Well, now more and more of that is at their disposal with Canadian listed products. And all things being equal, oftentimes the Canadian investor is better served to own something Canadian listed. And there's a lot of reasons for that we may get into, but it becomes a virtuous cycle, and it you know, augments liquidity. It provides more ADV, it tightens spreads, it lowers total cost of ownership. It gives issuers more of an impetus to come to market with more product, knowing that there's an increasing appetite among investors to look at Canadian product. And again, if you can customize a solution for the needs, be they tax or otherwise, of the Canadian investor, you're doing a good service for your Canadian clientele. And we're seeing that increasingly from Canadian providers.
All right. So this is my last question on the overall Canadian market, and then we're getting into these products. Because this one I get to say, I actually think the US is better at one of these things, which is our ETFs are still like an amazing tax haven. Like, you know, we all love to throw out tax efficient. It's more than that. I mean, you know, the tax benefits of the US ETF structure can basically turn your investment into what we call an IRA if you buy and hold it in perpetuity, right? 95% of ETFs in the US have never had a capital gain distributed. Like, that's all coming from the way ours work with capital markets. My understanding from some of my friends up there, many years ago, you guys didn't have your group, and Congress or whatever you guys call it there said, okay, we want to get rid of that tax haven. I look at Eric, she's like, you don't know anything. I know. I don't know what the politics system is up there. That's true. And then it took like 10 years to actually implement because it messed up the pipes of how the ETFs work. So correct all my mistakes, please, and explain what actually happened.
No, you're not wrong at all, Michael. Yeah, there are inherent tax advantages to U.S. listings, and we talked a little bit about it in the pre-show, where you can purge a portfolio of high basis securities and replace them. Sorry, the other way around. You can purge your more taxable positions. Yeah. And so, you know, that's going to net out to minimal to no year-end distributions for the holder of the U.S. product. We don't have that particular advantage in Canada, but if you think about it in the context of ETFs that are well managed, that have, you know, manageable turnover, they tend to result in minimal year-end distribution. So I wouldn't suggest it's a massive advantage, but we can't lay claim to the same tax efficiency when we're touting the benefits of Canadian exchange traded products. There are other tax advantages, though, of owning Canadian listed product, and we talked about a few of them. Cross-border withholding taxes, which are applicable to Canadian investors and are often not even top of mind when it comes to looking at the relative merits of Canadian versus US listings. You're simply looking at liquidity, you might be looking at cost, you're looking at AUM, but you're not thinking about much more than that. So there's a lot of nuance, and I'd hesitate to dwell on one particular aspect of something beneficial about Canadian versus US listed product, because it really depends on your vantage point. Because increasingly as the Canadian market matures and issuers take into account the needs of the Canadian investor, they can mitigate a lot of the apparent or perceived historical advantages of using US listed product. But your point is fair about that tax advantage as it relates to the ability to purge and minimize taxable events for US listings.
All right, Eric, is your question about the industry or a product? Just so because I got to give Dave, I've been holding David back.
No, I was looking at
Yes.
Eric's answer. I just want to say for Michael, that was an excellent answer. You kind of answered it, but also specifically answering it. You're really, really good at your job. Well done, Eric.
Michael's gone to media training.
Yeah.
That was media training.
That was a fantastic answer. So Eric,
I'm going to tell you though that our tax benefit is way bigger. So, Eric, you go.
Venuto is not a diplomat.
Yeah.
Eric,
you go, and then we'll
Canadian
talk
taxes.
money markets. Yeah.
So cross listings. Has anybody tried? What would it take, or is that just off the table? Listed in the United States. Yeah.
Right. I mean, you've seen in recent years, you've seen Canadian issuers that have gone south of the border, not with cross listings per se. And I think Eric, I'm not a tax expert, but I will say that there are restrictions on cross-border ownership of Canadian ETFs. There's the Canadian tax rule around what they deem to be Canadian taxable property for tax purposes that can compromise the tax structure of a Canadian investment fund if a disproportionate ownership is offshore, a disproportionate amount of the ownership is offshore. And I think that may present risk for issuers that look to go cross-list. 15 years ago, a firm I worked at went the other way and cross-listed US product into Canada and had some success that way, but not subject, at least as I understand it, to that same sort of tax risk that you would have going the other way. That's not to say that you can't take a good strategy. If you have a core competency in a particular asset class, you've got a track record of excellence in active management, there's no reason you couldn't export that into the US market. But again, do you have the brand equity? Do you have the access to distribution to do something like that? And frankly, I mean, all things considered, there's not a lot of innovation that a US investor could not just as readily access from a US shelf. I mean, what would be the impetus to look at something cross-listed unless it was a very unique IP that they would otherwise have difficulty accessing?
Let's say a maple flavored ETH.
Yeah. I wouldn't rule it out in the future, and I would suggest that at CETFA, we certainly have to pay attention to keeping the playing field as level as we can. Because of Michael's observation about tax efficiency, or the more mature at-scale market that is the US and the associated benefits of liquidity and other considerations, that disadvantages the Canadian ETF market to a certain degree. So ideally, we continue to maintain a level playing field, and where applicable, we have, among other things, a fair tax environment. I can tell you that, coming the other way, certain asset classes, derivative-based products, commodity products, is subject to different tax treatment if I'm a US investor, a US holder of product, even for a Canadian holder of US product. And that can be a little bit prohibitive. We understand the reasons for it in Canada, but it is sort of incumbent on us as the association and as members of the Canadian market to ensure that we have as level a playing field as we can. So I know I'm getting a little bit off topic, Eric, but cross-listings, I think, represent some limitations for us in the current environment.
All right, time to get into product. I admit I know very little about this, but it was the most intriguing thing I heard pre-call that just kind of blew my mind. And you referenced two different money market-like ETFs, one Canadian-based and one US dollar-based, both offered in Canada. And then the most interesting thing you said about that was the restriction of who can and cannot own that. And it just sounded like an amazing kind of straightforward rule that takes the intention of what's trying to get done and actually get it done in markets, which like has, I don't know, maybe never happened in the US. So can you talk us through that? Who can buy it? Who can't buy it? What are the two different ETFs? How are they pegged? Some of the details on it, because gosh, that might change the whole banking system in the US. But not joking, just yeah.
Yeah. There is some complexity certainly to this particular product category. So I'll try to keep it at a high level, David. But essentially, you have major Canadian financial institutions, Schedule I banks that accept deposits from retail clients, from commercial clients, from institutional clients. And depending on their balance sheet requirements and also the blend, like the regulatory blend of that funding that is prescribed to them by the Canadian regulators, they will look at different sources of funding and they will be subject to different terms and conditions in accessing that funding. So what the banks have done in terms of partnering with Canadian ETF issuers is to create a source of wholesale funding where these ETFs make deposits at a consortium of these Canadian banks. And that funding, in some instances, is treated as wholesale or institutional funding for balance sheet purposes among the banks. Now, again, we have a very prudent, financial system in Canada with tremendous oversight that regulates, the balance sheets of Canadian financial institutions and sets prescriptions on that ratio of retail versus institutional or wholesale funding. But there are different rates payable on that funding, subject to liquidity coverage ratios and other covenants that the banks, again, are subject to by the regulators. So what it has added up to is a bit of a yield advantage for these products that are treated as wholesale funding by the Canadian banks. So as opposed to, walking in off the street into my retail bank branch and opening up a high interest savings account and earning the applicable yield, which is at a spread to the Bank of Canada overnight rate, sort of like the Fed funds rate, you're earning a spread over that rate. So it is a floating rate. But as you can imagine, particularly in the last year and change where the Bank of Canada rate has gone significantly higher, that yield has gone appreciably higher. It's not a risk-free rate, but it is subject to the credit quality and the balance sheet risk of the Canadian banking system. A very defensive, high quality portfolio of assets. So it's been a very attractive proposition for Canadian investors that have looked at the demise of longer duration interest rate sensitive fixed income vehicles. They've looked at the NAV stability of these products. They've looked at what's backstopping these products, the safety and security of the Canadian banks, and the yields that are applicable here. Having said all of that, it is the strong preference, it is the mandate for these products to be retail focused. So the end investor is intended to be a retail beneficiary. And there's complexity as to why that is, but it has to do with the expected runoff rate of retail deposits as opposed to wholesale rates for wholesale depositors. You need to maintain a certain amount of stability in those deposits if you're going to pay a certain yield or yield premium. So there's a lot of nuanced regulatory considerations that go into it, but it has served to the great benefit of Canadian investors and advisors that have enjoyed this very attractive yield environment with the relative safety and stability of Canadian banks and their balance sheets backstopping these products. But as the market has grown, it has drawn more scrutiny from the regulators, rightly so. But it is another source of innovation in the Canadian marketplace. We'll see what the future holds. But in the current environment where cash has been king, so to speak, it's been a very defensive way for Canadian investors to earn very attractive yields. And because the Canadian banks have need for funding in both Canadian dollars and in US dollars. You've seen a couple of the issuers come with US dollar product as well as in offering Canadian dollar product.
Can you define intent? Because like you use that word a number of times, and that sounds like a crazy legal gray area, and maybe things are just done differently in Canada. But you kept saying the intent. Is that monitored? Like intent is, oops, sorry, I guess I forgot, you know, like what does intent mean legally? Is it monitored, right? Like, can a US institutional investor buy it, so or not, or an institutional Canadian investor buy it? What is intent in that?
Well, I would say that yeah, the intent is to strongly discourage institutional activity in these products of any description. But these are not, you know, open-ended mutual funds. They are exchange-traded products. So in theory, you cannot regulate the ownership of these products. But as a measure of prudence, Canadian asset managers do not market to US investors in general terms. And they do not market these products to institutional investors. That's not to say that an institution couldn't see this yield arbitrage and say, I'm going to take some of this down. There's no immediate term point of trade restrictions on that. So your intent is to abide by the regulations on Canadian retail beneficiary ownership of these products. But because of exchange traded, you can't regulate that in real time.
But before we go to Dan, I just want to clarify. These are ETFs that trade at a stable NAV, meaning there's not a Jane Street and flow traders, as Debbie was pointing out, deciding the bid-ask spread here. This trades like a money market, but on an exchange. Like that, like that would just break the SEC's brain. Like, yeah, right. Like when I heard about this, that to me is like an innovation that I don't see how it could work in our markets. All right, so Weisskopf, let's go to you. I just wanted to get that out there because that's the part that really is a different innovation. Yeah.
Let's break the SEC's brain. That might be the
I mean, people are filing for 2x Bitcoin, Ethereum. They don't even care about that. They're like, oh man, $1 NAV.
So I did an interview with VersaBank, which is a Schedule I bank, and it's relatively small. Can you talk to us a little bit about the banking system? Because it's very different, fortunately, than the US banking system, which is having so many different problems.
Wow, that's an interesting topic, Dan. I mean, you know, we do have a very stable banking system in the Canadian market. Some would argue that it's a little too oligopolistic. Some would suggest that it can be uncompetitive, but it's a very sound and secure system. We don't have the regional banking infrastructure of 6,000 odd banks that you have in the US. We do have the big six, as we like to call them. But we do have a number of independent banks that you know, are equally competent and stable and supportive of the Canadian economy. But it's a much more concentrated market than in the US. Arguably, it's subject to greater regulatory scrutiny. You know, 20 years ago, there was some M&A activity proposed among the big six banks, but for systemic reasons, the regulators did not approve. They did not want any further concentration within the Canadian banking system. So, you know, I think Canadians take great pride in the stability of the Canadian banking system, not to discredit the US market, but should be uninclined to see the same sort of, you know, SVB run that we saw recently in the Canadian marketplace.
Stability would be good, by the way. And I legitimately think, unfortunately or fortunately, depending on your vantage point, we're headed that direction, right? In the US, where we're going to see much more concentration, whether we like it or not. But the interesting part is, fact is, you guys have more concentration and more innovation. I think that's kind of an interesting duo.
For sure. And again, you know, the Canadian banks are great partners to the Canadian ETF ecosystem. We talked about providing liquidity. They provide seed capital. They support innovation. They support entrepreneurialism. They may become a little more discerning as we go forward in terms of what that partnership is going to look like in a market that is maturing and consolidating a little bit, but Canadian banks have been wonderful partners to the growth of the Canadian ETF ecosystem. I credit the regulators for supporting innovation, but with a prudent eye towards ensuring integrity and responsibility on the part of issuers, of asset managers. So in some respects, it's a perfect environment. I mean, we're not, we have our risk, we have systemic issues, but through thick and thin, and this is maybe a little bit off topic, but we look at the stability of the ETF ecosystem. You look at periods of market disruption in the last 10 or 12 years, and all the naysayers come out of the flock arguing about the stability of the ETF market, arguing about liquidity, arguing about pricing efficiency on ETFs. And time again, the market comes through it battle tested, and I put the Canadian market at the top of the list for the relative stability of the entire Canadian ETF ecosystem, which includes the partnership we have with the banks.
Could you give us a little more context on the tax efficiency that does exist in your market without the use of heartbeat trades, et cetera, right? I think most people on this call actually, which is no small feat, even in US markets, understand to a pretty strong degree what a heartbeat trade is. I think if you ask that of an average crowd in the ETF marketplace in the US like 10 years ago, it'd be much different. But what are the different dynamics? How are you still tax efficient in the ETF wrapper without it? Let's get into the details.
So yeah, there's a couple of great sources. If you go to the major US ETF providers and you look at their tax schedules for qualified interest income, QII, I believe is what it stands for. It will show you a schedule of every ticker on that issuer's shelf and what percentage of the income distribution is subject to foreign withholding tax, which in the case of Canadian investors is 15%. And it does vary by asset class. I use the example in the pre-call of emerging market debt. So let's say, I'm trying to remember my US tickers right now, EMB is an example. I'm a Canadian holder of that product, and I'm earning a 6% income distribution off of that product. Well, 15% of that's going to get withheld as that distribution comes across the border into my pocket as a Canadian investor. I am not subject to that if I own a Canadian listed product in that category. And especially on yield product, I would argue that 15% dwarfs other forms of tax efficiency that people talk about, as it relates to basis trades, as it relates to total cost of ownership or the perception of tighter spread costs or even lower management fees, although that arbitrage has gone away between Canada and the US. But if your holding period is a reasonable time, you're not talking about day trading or a very short round trip on your trade, these issues start becoming a lot more important to you as an investor, but they are not well understood. Now, some will say, well, I can reclaim on that 15%, but you have to instruct your custodian, you have to monitor, you have to incur cost. And I would suggest that a large percentage of Canadian investors are unaware or uninclined to ensure that they're not subject to that tax inefficiency. I know it's not part of your question per se, David, but just to go a step further and talk about customization, we talked about FX, strikes, and other nuances that thoughtful Canadian ETF providers have built into their product to ensure that they're conferring the most benefit to Canadian investors. And I think as the market becomes more aware of that, that $150 billion of US held ETF money by Canadian investors, a good chunk of it's going to get repatriated. There's always going to be a place for US listings and client portfolios. There are myriad benefits to holding US listed products. But as the Canadian industry continues to mature, there's more product choice, there's more competitiveness in terms of fees, there's improved liquidity. It becomes a more attractive destination for Canadian investors.
All right. I want to go to another product that you guys have that we don't, which is the Bitcoin ETFs. Like solving the spot problems for our regulators. I mean, nobody even knows exactly what they want at this point, but it it does look like there was an interesting filing the other day here from Grayscale. I don't think it's going to go anywhere. It's no secret that Dan and I run Block, which we do own the Canadian spot Bitcoin ETFs.
Right.
And nobody else does. And it was primarily because, we asked nicely and they said, keep it de minimis. I think if you ask nicely today, they still say no. So they're not held to consistency. I mean, what is it that makes your regulators comfortable with spot that we can't seem to get over here?
Yeah, that's a really good question. I mean, I know the SEC take on this is that, they're concerned about things like price manipulation and fraud. I think indirectly too, if you think about effective arbitrage mechanisms on any ETF, is there a robust market of hedging instruments? The futures market is still very nascent. Like it's very small in Ethereum. It's grown up a lot in Bitcoin. But if you start thinking about the hedging instruments that liquidity providers can use, are those reliable arbitrage mechanisms? And I think those are among the issues that have confronted the SEC. And with the sheer size and scale of the U.S. market, where you could see tens or hundreds of billions of dollars flowing in this market, especially with the apparent pent-up demand for spot product in the U.S., could that create systemic risk for holders of U.S. product? It's a debate to be had, but I think that's part of the reason why the SEC has taken a more cautious approach to this. And in some cases, they're to be credited. I think some of those concerns are overdone, and I think the OSC was very thoughtful in its deliberation about the Canadian market and prudently reviewed. Like this was on the table for years before ultimately approval was given for spot Bitcoin and crypto exchange traded product. It didn't happen overnight. So there's a lot of deliberation among Canadian regulators before getting to a point of approving on this stuff. You could argue, and I would argue this not just about crypto, but perhaps about gold too, where a lot of gold ETF issuers use futures to manage their arbitrage. And there's basis risk. Obviously the gold futures market is a lot more mature and liquid. So maybe that basis risk is further mitigated. But in emerging markets, like crypto futures, is it robust enough to support, billions of dollars of flow into a spot Bitcoin product that is reliant on futures markets for arbitrage? I think that's a legitimate consideration, and perhaps one that we in Canada don't have to worry about on such a scale, given the relative size of our market. So those are just a couple of high-level observations, Michael. But I think our regulators did take a very prudent approach to this. I know Grayscale is lobbying vociferously to get regulatory approval, I believe, to convert their own closed-end fund, and we'll see what happens there. But as Dave Natick said recently, I think what you said, Thea, crypto's not going away, Web 3.0 is not going away, blockchain is not going away. So it's hard to see how ultimately we don't see the commercialization of these spot markets, but perhaps we need to see the broader infrastructure of capital markets and liquidity provision mature alongside that before we get to a place of comfort for groups like the SEC.
Man, we're texting each other back and forth. You're just smooth at this, man. You've got this down.
Yeah, we need your help in the US here. Can you come
Well,
our side?
why don't we ask, since you guys are in the business of firsts, and I think we all could use a quick drink because I'm parched.
Yes.
What's the next first? Where else are you going to scoop us? What comes
Good,
next?
Cynthia.
Well,
that's why she's the head of research.
I won't call it a first because I know that at a previous firm I worked at, we had a very popular S&P 500 buy right product. Now this is going back almost 20 years. So the concept of covered call strategies has resonated really well in the Canadian marketplace to a much broader degree, I believe, than we've seen to date in the US, even though I wouldn't suggest we're a first mover. But perhaps a first adopter would be a more apt description. So we're seeing a proliferation of these kinds of products, which are very applicable and relevant in an environment like this, where you can mitigate volatility, where you can generate very attractive current income. Those have become very attractive solutions in the Canadian market. I'm jumping around a little bit here, but you know, there may come a point in time where a broader array of cryptocurrencies can be paired with the ETF structure. You know, who knows what the next several years are going to bring in terms of the emergence of other coins or the maturity of blockchain. You know, it's interesting as a sidebar that you can lay claim to, I think, the Boston Stock Exchange becoming the first blockchain-based securities exchange in the world, which is going to accelerate, you know, settlement from days to hours and create all kinds of efficiencies for trading. Are there some interesting, perhaps operational firsts or nuances that can be accessed through the blockchain technology? We've got some interesting innovation happening there. I'd like to see us do some more of the things that the US has been quite sophisticated and successful at. You know, as a former business head, I looked with envy at some of the solutions I received coming out of the US that cater to different investor segments: institutional investors, retail investors, DIY investors. You know, the holy grail is to draw support and ultimately scale from all three of those distribution channels, but there are certain types of products that cater more to one channel than another. I'd like to see the Canadian market reach a point of maturity and scale where we can create more of those solutions that are customized for a particular distribution channel, because I think we could do some very creative things here. I think the commodity space is very interesting, and that comes with its own operational challenges and limitations. You know, I was reading the other day about how in Canada, the commodity ETF segment is very small here because it's dominated by gold and silver, and to a lesser degree, natural gas and crude oil. We don't have any broad-based, you know, sort of composite commodity products in Canada that I think are very attractive asset classes for diversified portfolios. And if the gold trade is off, as it was for much of 2022, that's going to significantly dent the demand within the category. And I think it's a shame, because I think commodities, currencies, and other asset classes have a rightful place in portfolios. So I think there's some innovative things to happen there. On the other end of the spectrum, and I know not everybody agrees with me on this, but I think about bodies like IOSCO, who recently came out with a paper, Good Practices for ETF Issuers. And among the things they talked about was the risk of over-engineering and asking the question about whether, in fact, a particular asset class or investment strategy is best delivered through the ETF structure. You know, there's a lot of innovation and creative and value-added solutions available to Canadian investors, US investors, but it's not necessarily the case that they're best delivered or accessed through the ETF structure. And I think IOSCO and others are asking local jurisdictions to take that into consideration, perhaps to improve upon things like classification of different types of either asset classes or structures or substructures within the ETF market. I think we need to be better at that, and perhaps we can be a first mover for the marketplace in that regard. But I think there are limits. You can over-engineer. You can introduce too much complexity, too much cost, you know, too much operational risk into a product. So it's something else we need to be mindful of as we think about innovation and being a first mover. That we don't want to overshoot the market. We don't want to overshoot the regulators. We want to make sure that we're delivering value-added solutions to the marketplace.
Well, you don't know, but in my head, I keep hearing structure matters like 100 times in my head. Sorry.
Yeah. All right, Dan, you got the last question. So
well, yeah,
get it in there.
It isn't so much of a question, but it's a thought, Michael. Just I do know that a lot of innovation is coming in Canada around blockchain. So just keep me in mind, and candidly, if there's a company or two that comes across your desk, let me know, right? Because we're always looking for companies, to
He's not looking for a job. At least we don't think so. I think he means for investment.
For investment, he's looking for something before TMX Group buys it. Listen, this has been great, Michael. We really appreciate you coming, educating the group. Like, this has been one of more educating shows for me, because like there's all these like tangential things. Like I know Richard King, 20 years, he's been telling me about the Canadian market. I see him down there. but I don't really get to ask all these big questions. I mean, if you're the advocate for their industry, good for them. Well done. Thank you very much. I don't think we have a show next week, and then we have a special show from Hollywood, Florida the following week. So we'll catch you guys on the next one. This will be out as a distilled early next week, and we really appreciate it. And have a great day, everybody.
Thanks, everybody.
Everybody.
Thank you.
Be with you.
Thank
Take care.
you. Be the first.
Be the first.